So, welcome to today's podcast. Thanks for joining me as always. I'm so appreciative of you as listeners, and hopefully you're getting some value out of this. We're really just trying to educate and empower everyone to, basically own their own financial lives. And, really we get so much joy out of coming on and doing these podcasts, whether it be solo or, with guests. So thanks again. So at the time of this recording, we're close to the end of the year. We're coming up on the holidays, which could be very stressful for some people. I know I've seen it and talked to many folks. It's kind of ironic sometimes I think about it. It's supposed to be the most enjoyable time of year, or at least one of, and it can be super stressful. And I think some of it's self-imposed. I know that happens with us too, but hopefully people will get to enjoy it. So, you know, one of the things as we're experiencing the holidays and approaching, say, Christmas, whether we celebrate that or Hanukkah or other holidays, we have to give presents to people. And, just like in our busy lives, we may not get to it. And I'm certainly guilty of that. And I guess as I get older, it's like even harder to figure out what to buy people anymore. But at any rate, you can put that to the last minute. And we don't plan for these things. And so what happened? So here I am trying to buy certain things, either not available or they've jacked up the price or too expensive, or to get it delivered in time is going to add some extra cost. And so it becomes a very inefficient model because I didn't plan properly. Right. And I know this is a small snippet of probably most people's lives, but it's still sort of symptomatic of something that I think is a challenge for all of us in our busy lives, is to plan ahead for certain things. And so as it relates to kind of year end, which, now as you start talking to folks and they're maybe had a different year, in their business or their work or some windfall or something, that they have an unusual tax circumstance in their lives that they're trying to figure out how to mitigate their taxes. And they're coming at the end of the year, just trying to figure out what to do. And unfortunately, these things require some time and effort to explore, do the proper due diligence, and put things in place. So it's really incumbent upon us to really get ahead of these things and to plan properly, because then it gives you time to weigh different options and go exploring, versus this sort of very forced time frame towards the end of the year to do this. And it becomes very stressful, and options are fewer, and it's just can be expensive to do it. And it's just kind of you're likely going to get into suboptimal solutions. And unfortunately, as I've come to become a little bit more knowledgeable about the accounting profession and seeing it, that they're taxed too, because they're so heavily focused on the compliance arm, which is super complicated and complex, and it seems like it grows in complexity by the minute. They may not have time or knowledge or expertise in the area of tax planning because they're just so consumed with just trying to keep people compliant with their tax reporting. So it's just a difficult challenge overall. So, but if you're somebody in a situation where your tax bill continues to grow, which is, we're looked at obviously as our biggest expense we're going to face in our lifetime, especially if you're successful, you're going to run into this, and it's going to certainly create a sort of drain on your wealth and your ability to save, invest, and essentially live the life you truly want. And, I'm a big believer in the idea that the tax code is a set of incentives put forth by the government. And if we just follow it to the law, that we can, do what they would want us to do broadly to support the economy, support our families and such, and at the same time, reduce our tax bill. So, this is where I applaud you for coming on here to get educated and learning more, because the more you get educated, the more empowered you are to actually keep more of your money. Right. And so then you get to choose how you want to use it. So today, and I just want to warn this, today isn't specific tax advice. Really, I just want to frame this up to give people an idea of maybe what they should be thinking about exploring further, right? And talking even over with their accountant or CPA or enrolled agent to kind of explore options for them, and doing it earlier in the year. So as you kind of get into the future year, maybe this is a good time to sort of bring up these topics with your CPA or your advisors, financial advisors, and sort of get this out in the open so you can include it in your kind of normal planning sessions as you have them throughout the year. And unfortunately, from conventional wisdom, when you think about tax planning, you most advice, more generic advice, is centered around deferring your tax bill, so you put money somewhere so you can defer, so you don't realize the gain or that income this year, but down the road you're maybe sitting in qualified plans that are government plans that eventually will be taxed, and we're not sure what that tax rate will be. And based on your income, we don't know, and the code at the time. So it's just kicking the can down the road. There's no guarantee of a cost savings in that mix, because if your tax rates are higher down the future, you're actually paying more in taxes. So there is kind of a guessing game there. The way you win, I guess, in that situation is you have less income in retirement than you do while you're working, which I don't know if that's a win in itself. I don't, that strategy to me never really made any sense. I'm going to have less income when I'm basically on vacation all the time. I don't know if that's a good recipe for success, but that's kind of how the conventional wisdom pushes us. So I'm asking you to think a little differently about it. What if you actually had more income in retirement, whatever that means to you, or later stages when you have more time to enjoy it, go travel, give to charities, whatever it is? I would imagine you would want more income, not less. But so I'm going to frame it up on a couple of different ways. One, so let's start with the kind of buckets of areas when we think about tax planning. And I would almost put these in the order of importance in terms of potential cost savings to you, real cost savings to you. So let's start the basics. So deductions, and you may have, depending whether you're a W-2 employee or own your business, might have a different sort of meaning. But in terms of deductions, most people probably equate it to maybe you may see it as a standard deduction. So it's going to reduce your taxable income, the amount of income that the government will recognize as taxable. And there's things that, you make say $100,000 income, but there's things that are going to deduct from that you can then sort of show a lower amount of what they call taxable income or adjusted gross income that then the tax rates will be applied against. And so standard is good, and it's pretty high now, depending on what happens with the tax cuts that Trump put in previously, whether they're going to hold, into future years, but it's pretty sizable now. So you take that, I think it's over 25,000 now. So you take that off your income, good thing to know. But if you're itemizing, then you can take advantage of things like paying for interest on your mortgage or state local taxes. If you had a lot of healthcare, bills, there's certain rules around that. So then those are just kind of itemized deductions, if you will, if you're eligible. If not, then you take the standard. So that's kind of the basic stuff. Obviously within the tax code is really geared towards business owners. So, but before we get there, sorry, and there are other things like depending on where you're investing, you could get deductions off your income. Say if you invest or an active investor in oil and gas drilling sort of deal or investment, those are things you can sort of use against your normal W-2 sort of employee income to offset the tax bite on those sorts of things. So on the business side, obviously, the good thing about business, and this is why it kind of changes the equation a little bit, because some of the expenses that are incurred to substantiate your business and support your business can be applied against your revenue that you generate for your business. And then the net income, not the gross, like as an employee, the net income is what you're going to be taxed upon. And so you can have things like buying equipment or inventory or buildings, or, obviously paying your employees, all those sorts of things to support the business will be deductions against your income that then reduces your taxable amount, right? So we're not going to go into big discussion on structure of your business in this conversation, but there are some things around that. But by and large, you get the fact that there's certain things you can deduct, and say you're working from home, right? You can deduct aspects of your home, right? The mortgage and the utilities to support your home, right? If you have a home business, a portion of your home is dedicated to that as an office, and the expenses come along with that. So that's where you can infuse some of what, even though they're, partly personal expenses that are tied to you. If you're using them for legit business purposes, those things can offset your income and reduce your tax bill. So this all gives you a flavor for the deductions. That to me is probably the most powerful because it's just reducing your income that gets exposed to the tax system. The second kind of big bucket area are credits. So we start with deductions, reduce your income. Credits are pretty powerful tools themselves, and credits are essentially a one-for-one reduction of your tax liability. So, if you've done your deductions, you deducted everything you possibly could legitimately to get to a adjusted gross income, and then there's tax applied to that. Now you have a tax bill. So then you say, okay, well, what are maybe some things that I can pay that tax bill out of pocket, or you get a credit that can be applied one to one against your tax liability. So it kind of comes later. So there are personal things like, and again, it's a government incentive type things like solar. Like if you invest in solar to put panels on your home or something, then you can get credits from the government that can offset your tax bill, right? And so those are types of things like that. And childcare, right? They want to help you with those things. So there are credits that are potentially tied to offsetting your tax liability, to help support you on the things the government feels are important. On the business side, as you can imagine, again, this economy is really built off businesses that create jobs and kind of helps the economy grow. So businesses have a lot of options, say for research and development, or the types of investments they have in their business are employment. Even one I came across like in the film industry where if in certain states, you can get film credits where if you're producing a show or movie or something in a state, they'll give you credit for doing that because they want to incent that sort of business. So there are a host of ways that you can apply credits, depending on the nature of your circumstance and even in your state, they may or may not be available, but they can help you figure out like how to maybe offset your tax liability on a one-for-one basis. So it just helps reduce that for you. The third sort of category I would sort of classify in this is conversion. So, you think about the types of income, they're not all the same, right? Whether you make income, and if you've ever come across the cash flow quadrant where you have, employee or self-employed or a business owner or investor, with that are obviously the nature of those activities are different, but they're all going to be taxed differently and treated differently. This is just the nature of our fun, complex tax structure that depending on how income is created, there might be different ways to tax it. And so that's why when you're thinking about your own income and, the highest taxes are likely the employee or the self-employed. Like if you're a solo prop person, those can be very expensive because you have, earned income that you have to pay self-employment tax on. So, that's one of the strategies we know about is maybe as a self-employed person, you can pay yourself a wage and then the rest of the net income from the business then can be deployed back to you as a distribution. So you don't have to pay self-employment tax, which could equate to like 15+%. So, these are ways to just kind of convert the income from earned income to say maybe ordinary income. So that's one example. Another way is to get down because they want us to invest. And so you can take, say, earned income and maybe put money into investments, whether it be the stock market, real estate, or so if you earn income through capital gains or dividends or rents, passive income, it's going to be taxed at a lower tax rate versus what you would experience if you were just working a job. So that's why it's important to, not only invest for your future and help your money grow, but they want to encourage that so that, then the tax rates today, as they currently stand, like capital gains rates are lower. Like, top one's 20% on, if you make a lot of money, then there's like an investment tax on top of it, but, it's going to be the 23-24% range instead of the earned income ordinary rates of like 37. So again, you can sort of position money and assets and things that will create lower tax burdens. The other arm to this, which you kind of alluded a little bit to, say rental real estate or something like that, you can turn active income, and if you, depending on where you're investing, you can turn it into passive income, and that can also generate some things you can offset that income against, whether depreciation, things of that nature. That and because it's a passive nature, you can shrink the income that's subject to taxation, and certainly some of it, those passive losses can be carried forward, and you can aggregate those passive losses across the board, depending on kind of where they're generated. If it's always a passive loss, they can all be offsetting any passive income too, so that, your passive income isn't taxed potentially at all. So these are the types of things to consider as you're exploring where to invest and deploy your capital. And then lastly, obviously, to try to get any income into, say, a tax exempt sort of space. And some of this hits on maybe Roth IRA type work, muni type bonds, and things that are, not going to be subject to taxation. So those are areas also to consider as you're exploring where to save and invest. So the fourth bucket that I think is key, and I don't know if everyone appreciates the brackets, right? So we live in a progressive tax bracket system. And so obviously portions of your income are taxed at lower rates. And as your income rises, right, different ranges of your income are going to be taxed at different rates. And so it's a progressive nature. And that, as it stands today, the top tax bracket is 37% that we experience. And that's fairly low as it relates to, if you look at it through history, there used to be a time when the top tax bracket was 80, 90%. So we're at pretty historically low tax brackets, even though maybe some days it doesn't feel like that. But if you look at our history, we are. And so playing, playing against and knowing this and playing the game to understand, like, where am I going to get my income and how do I manage these tax brackets are key. So there could be income splitting where, if you're making a lot of money that maybe you don't realize it in this year, if you have a lot already, you can put it into a subsequent year or something like that. You can delay your customers or clients or something in that nature. You can defer some income, from your job into years where your broader income is lower. So then, you experience more of the lower end of the tax brackets. One of the ones that, for business owners and privately owned ones, there's ways that you can pay your kids if they're working legitimately in your business and doing a job, then they can get paid, but you're paying them at a extremely low tax bracket, in some cases zero, because they don't have a lot of other income. So then they can basically take all of that money tax-free, essentially, and then you can deduct that as an expense because of the legitimate cost to your business to support it. So those are ways to kind of split the income and across and then take advantage of those tax brackets. Things like Roth conversions, like especially if you're in a lower income year, Roth conversions, they're associated with qualified plans, whether they be 401ks, IRAs, that type of account. Unfortunately, we get a deferral on the front, but then, someday we're going to have to pay tax on that. But government has allowed us to now switch that to go to Roth, right, and convert that and pay the taxes on it. So, in given time that there's something unusual what's happening within your life that you have low income, then that might be an opportune time to do Roth conversions, pay the tax, hopefully the lower, and then put it into a Roth sort of wrapper that will no longer be taxed in your lifetime or your heirs' lifetime. So, these are things to consider. Sometimes something negative happening in your life, you actually get turned into a positive in that sense. And because your income is a low, or you just had circumstance transitioning and such. So, you might want to consider that in chunks. And people who are going into retirement and realizing they basically have all their money or most of it in qualified money that or 401k IRA that's going to be taxed, that doing this strategically over time to not break through to the next higher tax brackets is key. So that's why you work with advisors to do that, maybe in chunks, if that makes sense. The other aspect of this is we talked about too, capital gains, like putting into certain types of investments, right? Stock market, real estate, business. Like when you sell those assets, if you do sell them, you can realize lower rates on that because they consider capital gains on an investment. So it's important to realize why it's so important to put it into those uh, types of assets, and because the tax rates are favorable in that sense. So, if you sell your stock, even though it's going to be paid for the pay tax, you can, experience 0 to, 15 or 20% tax bracket instead of maybe the ordinary incomes at the highest one at 37. And obviously with that too, the concept of tax loss harvesting, where some gains and losses can offset each other. So, again, that's where you need some strategy and timing and review to plan for those things. So you can, maybe take some of the winners and sell them without any taxable gain if you have losses that you're already planning to sell. Now, the last bucket is one that I think most people are familiar with, and then kind of started this way, where that for a lot of financial advice out there, the conventional, this is kind of the starting point, right? You defer, right? You either put some money into a 401k, an IRA, and you defer that to the future when, hopefully that's grown, and then you take that out, then you pay the tax on it. So you're just kind of waiting. So, there's no guarantee that will be a cost savings in the end, but you're just essentially deferring it. So that's kind of the core. So there's certainly benefit to it, especially if you're getting a match from your employer and putting that in, but the money there is growing tax deferred. And then unfortunately that you're going to pay the taxes on that when you use it in your lifetime. And if it goes to heirs, then they're going to be subject to their tax brackets too. So, unfortunately, you may be experiencing a little bit, as the baby boomers age and transfer wealth, that, it's going to go to heirs that are also in higher tax brackets, and they're earning years 40, 50 years old, and have to use that within 10 years. And that's the kind of rule around that today. So you just got to know what you're getting into. There's pros and cons to it, but you got to navigate that and sort of take that into account in your broader financial life, and sort of have a balance to it. For folks who are, have, businesses or real estate that have appreciated over time, and basically, you've deferred because you haven't sold the business or real estate, you could, use some vehicles to basically take those gains and exchange them, real estate for one, like a 1031 exchange, and sort of use those vehicles to at least continue to kick the can down the road. And, for real estate, for instance, that would be a very, given current rules today, you could continue to do that. And then if you died, they have this concept of stepped up in basis where, that gain is basically gone, goes away, and your heirs get that with the stepped up. And if they liquidate, they don't have to sell. Not experience any taxes on that. So those are sort of the strategies that are in play today, assuming the laws stay the same, which we know they can change. But that's another key strategy. There's a concept: buy, borrow, and die. You buy something, you borrow against it, because that's not taxable. And then when you die, then all the gains are basically forgiven. There's no taxes on. There's just that's maybe for another episode. We talk through that one in a little more detail. So there's other options here, like maybe you've heard of them, like opportunity zones, and again, taking large gains and putting it into areas that the government has deemed as needing support and economic growth. So those are areas, they're kind of opportunity zones that you put that in and get defer a little bit of your tax payment, but then put them in vehicles where they're going to grow, tax deferred, and then any gains from those could be tax free. So a nice sort of combination if you're needing those funds and you're comfortable with the investments, that it could be a significant sort of benefit tax wise in the long run for you taking that risk and deferring those taxes. And the last one, if you're selling a business, this is just an example of it, selling a business that you do it over time. You don't sell the whole thing at once. You can kind of do them in chunks and, deferred sales and installment sales type stuff, so that you can experience those gains that you've accrued over time, not all at once, right? If you just sold. So those are just some ideas to kind of defer it a little bit over time, even though you're going to pay it. And maybe in those years, you'll be at a lower income level, and you might get a lower tax rate on those sorts of deferred sort of sales of your business or real estate. So I hope this was helpful to give you a flavor. Obviously, this was not an exhaustive review of all the different strategies you can think about, but you can tell even just by this sort of flyover of the types of things, tax planning requires you, to do this properly, requires working with the right professional, your CPA, your financial advisor, maybe legal support, to really plan this out over the course of the year, not just at the last minute in December when you realize now I have a tax problem, right? Some people, maybe that happens without their knowledge of, and something happens toward the end of the year that they weren't anticipating. But you know, most people know as they're seeing success in their business, either jobs or things that are happening, these are things that raise up earlier than later so that you can plan, evaluate different options, and some of them do get super complicated. So it's important that you have the time to do the proper due diligence and bring in the experts in the conversation so that you understand what you're getting into and the risks associated with it, if there is any, and knowing how they operate. And unfortunately, it does take some time and planning, but I truly believe, like, if you did this right, that you could do it, save a significant amount of wealth, do it in a legal manner, safe, right? There's nothing that's risk free virtually in this world, but with mitigating the risk around it, and that suits your broader sort of situation and takes into account all of that. That's how I think you should do it properly, safely, and actually support what the government's already wanting us to do anyway, certain things, while we can benefit from a tax perspective. So I hope this was helpful, and we'll see you on the next episode of the Perennial Pride Podcast. Take care. Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride Podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.